Good day, ladies and gentlemen, and welcome to our class on the triple header strategy, or how to combine three easy indicators into one trading strategy. Today's class is brought to us by LegacyFX, one of the world's leading providers of CFD and Forex trading. Legacy is a fully licensed and regulated Forex broker. They offer the most advanced trading platform from MetaTrader 5, and it is one of the most powerful platforms in the market. You can get financial market analysis and charts and technical indicators right on your platform. It's a user-friendly interface, and it's available for PCs, Macs, and smartphones, tablets, and iPhones. You can either use, or you can combine however you want, the desktop downloadable version of the MT5 platform. You can use their web trader, where you can trade anywhere around the world by simply logging in using your username and password. You can use their Android device as well as their iOS platform, so that you can use it on all Mac devices. You can also, with the MT5 platform, add in algorithmic and automated trading. You can build your own trading robots and build your own expert advisors for your platform. So basically, you can use it to build your own black box system if you wish. Now, today in class, if you wish, if you go to www.legacyfx.com and click on the open demo account, and you can open a demo account and try out their platform. There's no fees, no credit cards, no deposit required, and you can try out any of the versions of the MetaTrader 5 platform. Because at Legacy, their philosophy is simple. They offer focused and personalized service that makes trading logical. Legacy cuts through the excessive jargon and provides financial content in a language that is comprehensive for all. They offer competitive trading conditions. They're fully compliant. They offer free trading tools and simple and fast deposit withdrawals and trade executions. They also offer their advanced education center, where you have a wide range of tutorials and courses, live webinars like you're attending today, periodical market research and analysis, and financial trading tools. Everything you need to be a knowledgeable, successful trader. And now, all traders that are clients of LegacyFX get the Auto Trader scanner and signal program. Auto Chartist gives you some of the best scanning, trade alerts, forecast ranges, everything you need automatically built into your platform. You set it up, you decide what assets you want to watch, what signals are important to you, what patterns you'd like to see, and it will scan the markets and let you know when something is happening. Now, because Legacy is a regulated provider, I am required to give you a risk warning, and then we'll move on with today's class. Trading foreign exchange and contracts for difference are complex financial products that are traded on margin. FX and CFDs carry a high level of risk, since leverage can work both to your advantage and disadvantage. As a result, CFDs may not be suitable for all investors. You may lose more than your invested capital. Now, today's class is being recorded, and if you wish to see a recorded version of this class, you can do so by using the same link you used to come to today's class in about 24 hours, and you'll see the recorded version of today's class. Or when investing.com has had time to edit it and clean it up, where you signed up for this webinar, you'll be able to find it under their education tab and then webinars on demand. And in fact, there you can go see all the classes we've offered over the last 7 years. Now, in today's class, I'm going to intermix the term security and asset. I might say Facebook, I might say Google, I know I'm going to say the euro, I might say Bitcoin, but I'm not talking about any specific asset. I am talking about all publicly traded financial instruments in which an open market exists. It's just a very, very boring thing. Security, security, security. And on that same note, I also intermix the terms investing and trading. You and I know the difference. Typically, an investor takes a longer term position, while a trader takes a much shorter term position. But in either case, the basic concepts and techniques presented in this class are equally adept. Again, it just gets very boring saying trading, trading, trading. Now, one of the most consistent questions I get asked, whether I'm doing a seminar, whether I'm doing a conference, whether I'm doing a one-on-one new trader seminar, whether no matter where I am, I tell you, I get it at dinner parties. Everybody says, what should I buy today? What should I sell today? What are the prices going to be tomorrow? Now, wouldn't investing be easy if we knew the answers to these seemingly simple questions? But I don't have a crystal ball and I don't have a Ouija board. So if you're attending this class in the hopes that that's going to happen, too bad. Sorry for you. However, if you're attending this webinar with the hopes that technical analysis and our triple header strategy will improve your trading investing, I have good news for you. It will. But you have to keep in mind that trading is all about filtering out so you only end up with high probability trades and managing your risk. So let's get on with our triple header strategy, or building your own triple header strategy. Now, there are probably as many trading strategies as there are traders out there, but not all trading strategies and trading plans are created equal. And I guarantee you're going to find a billion gurus out there preaching their own little thing. Now, I'm going to suggest to you to find some strategies and then build a trading plan around them. There are a plethora of trading strategies available to you, but I encourage you to create your own strategies. Now you're saying, whoa, that's difficult. I'd much rather follow the steps that somebody lays down for me. But you can always start with something that exists. Where I'm not lecturing you to start everything from scratch, but somehow or another you need to make the strategy your own, because I'll never convey every insight I have in my head, every little innuendo of that strategy. I couldn't write a book long enough that could teach you everything that is about my personal strategy. It's about, remember when you learned to drive? I can barely remember back that far, but you know, you either took driver's ed, you memorized the book, you read all these rules and you memorized them. You took an exam and they were just rules. Stay behind this car by 50 feet, stay behind this stoplight, this speed zone, that speed. They're rules. Well, that's easy to teach you. Now, I can give you a set of basic rules. Okay. And a trading strategy needs a set of basic rules. But then remember, you had to go behind the wheel and start learning how to actually drive with an instructor or your dad, whoever took you out. And that's the scary part. But remember when the instructor was in your car, you were so focused on everything, your hands at 10 and 12 or 10 and 2, whatever it was. You watched your rear view mirror, you did this, you did that. And in a while, you could drive in traffic, but you were so concentrated, it wasn't an enjoyable thing for you. And there was nothing automatic about it. You were focused because the driver's education person or your folks were making you focused. But then you got your license, you got on the road, and after a couple of times of driving yourself, you started to relax. You started to understand how to do things. You started to be able to predict. You started to be able to see things. You started to have your own strategy and you understood it. Could you explain that to your kids today? No, you're going to explain to them exactly the way we taught you, because it's just a feeling of experience and understanding, knowing your car, knowing yourself, knowing your response times. So I always encourage traders to develop their own trading strategy, time permitting. There are several reasons why I believe it's important to traders to develop their own strategies. First of all, creating a strategy requires the traders to develop a greater knowledge of the markets and its price movements. And I can't tell you how many times I meet a new trader or get emails from traders and they're bitching up a storm. They're blaming the platform. They're blaming everybody for them losing their money and their failures. And they'll say to me, well, this candlestick did that, and I did that, and this did that, and that did that, and I lost all my money. I said, who told them to do that? Did they make any decisions? No, I watched a video somewhere along the line, and it told me if I do this, this, and this, and when this happens, I'll make lots of money. Come on. So when one develops their own trading strategy, they are tuned into how the strategy actually works. What causes it not to work, and they will be much better at making the adjustments when needed. Even if you trade someone else's strategy, you need to test it thoroughly. And in the process, make it your own as you learn the ins and outs. And hence, one of the main reasons, even traders like myself who've been trading since 1972, today we have a lucky thing called a demo platform. Most successful experienced traders still have demo accounts. Okay. I do everything and anything and every adjustment, every fine tune I do on a demo platform till I test it out and see how it performs. Trading isn't about rushing. Now, this can be a time-consuming part, but if you make it fun, if you make it enjoyable, it can be quite rewarding. Okay, if you become so focused on money and not focus on the enjoyment of the trade, you're never going to be successful. If you can get reward out of saying, look at that, I tweaked that guy's strategy here, and I tested it here, and then I flipped this into my own, and now I've tested on a demo platform for 3 months. I've done hundreds of trades, and it works. I've done better than the pro did because I made it mine. And to think about the Forex market and CFD trading is you're never missing an opportunity. Everybody thinks they're missing an opportunity. I can't tell you last month how many people called me about oil. Do you know how many people I told, please don't go sell or buy oil? Everybody I know. My lawyer called me. Yeah, he's never traded anything. But oil was in the headlines of the paper. It was down at negative. They didn't understand why it was negative. Well, anybody's crazy not to buy oil. Do you know how many people I had to tell, do not do this? They were all thought they were going to get rich overnight. Now, if you were trading, you had some rules, you had an investment. Most of the people didn't even have, not a CFD account, an investment account. They had their retirement account, but they didn't have a broker. They didn't even know, I want to buy oil. Are you going to buy a CFD? You're going to buy a commodity? You're going to buy a future? You're going to buy ETFs? You're going to buy a certificate? What are you talking about? See? Now, once you start and you start to build, you want to analyze your charts looking for opportunities. Now, the way I look for a strategy or I look to adjust a strategy, I look to add in indicators. I look at charts to see where there was a potential to make profit, whether it's up or down, that I did not see, that I missed entirely. Not that I didn't trade it, not that I traded and lost. If I'm looking at the euro US dollar and all of a sudden I see the euro US dollar move 62 pips over 2 days and I never saw it, I say, okay, what would I have needed to do to have actually seen the possibility of this move? So we want to examine those opportunities and instruct how to turn those opportunities into real money without exposing yourself to excessive risk. And this is one of the most important parts, because you know what? It's really easy to go back and look at 22 different possible trades. Say, I could have done that. I could have done that. It's how would you have done it without having high risk? How would you have done it to fit your risk reward ratio? How would you have done it and been able to set a stop loss? It's easy to look at the market when there's high volatility and say, look at that. I could have traded Bitcoin and went up $1,000. That same $1,000 profit had the same $1,000 risk. Okay. So how would you have actually What strategy would you point out? And then how would you have minimized your risk and stayed within your risk reward ratio? But then we want to check out our tweaks or our strategies or our adjustments to what we build our own for at least 20 or more trading signals and see how long see that it was profitable in a demo account. And we want to test it and we want to use it over time. Because you know what? Sometimes a strategy looks like it's perfect, but for some reason it worked today, tomorrow, the next day, and then it stopped working. Because it might only work when you're in a certain risk off mode and a risk off, or might not have just actually worked. It might have just been a whole bunch of lucky scenarios. But then you want to filter your inputs. And this is what a good strategy is all about, a filter system. We can all find possible trades. We want to filter out all the iffy trades, all the potential trades, so that we only end up with high probability trades. Because like I said, the market offers tons of opportunities. If you throw this trade in the trash can, say, I'm not going to make that because it didn't get completely filtered out, or my risk reward ratio. And then you go back the next day and say, look at that, I could have made 500 bucks on it. Well, that's kind of redundant. It's kind of self-punishment, because you could have also lost 500 bucks. So if it was, the market only offers one opportunity a month and you miss this opportunity, so you can't trade for another month, well, then we want to be a little bit more cautious, but it doesn't happen that way. The market offers opportunity on top of opportunity on top of opportunity continually. What you want to do is find the best opportunity. So remember, not all trading advice is good advice. Figure out where the advice has come from, how much you can trust a source. Then you want to test and modify it. So when you develop your trading strategy, you'll start out with a set of recommendations from analysts and other traders. Try these out on a demo account and modify them to see what happens. You don't need to reinvent the wheel. Okay, you can learn from trading analysts and experienced traders. They're still in the market because they are successful. Study their strategies and learn from them, but don't follow them blindly. But test out what they are saying, see if it works, and see if you have all the innuendo, all the ins and outs, all the little things that guru didn't put in his 1,500-word article. No, he might have been able to write a whole book on its entire trading strategy. But when you're reading a 15-word article and watching a video, you're missing a lot. Now, the other thing you have to remember, and we're going to get around to start putting this together, but you have to understand where your thinking comes from. Not one strategy for everything. Okay? You can have separate strategies. You can have a strategy that just issues trading alerts. You don't use it for your stop loss, your take profit. You don't know if it just, when this happens, this happens, and this happens, this tells me there's a trading opportunity. Now I should take it to a different step. Or do you want to just give you entry points? There's ways that you can have certain strategies. You've decided, okay, I'm going to trade the euro to US dollar long. I want to enter it somewhere around 142. Okay. But I need something to give me the best entry point. What number or what am I going to wait for to actually physically enter that trade? Okay. You can have a strategy that tells you that. So online trading is considered by some to be one of the most challenging styles of trading, which is why it is important to jumpstart your journey with proven day trading strategies. Success in day trading requires constant technical precision, emotional restraint, and mental focus. So the first part of building a strategy, you want to think differently. You want to think individually. So trading is simple, but it's not easy. That's why effective trading strategies are vital. The reason it's not easy is because it's an ongoing exercise in psychology, and invariably we get in our own ways. To correct this, we must recognize how we have been programmed to think and then try to begin to think differently. Okay. One of the things about having strategy, it takes your emotions out of the market. It takes your guessing out of the market. It takes your maybes, ifs, and possibilities out of the market. So a sound trading practice is not to take this information at face value. Rather, think differently and validate the statement about the product to see if there's a bona fide trading opportunity. Then we want to start planning our strategy. The best way to rein in emotion is to have a trading plan and to read it and check it daily. Day traders have numerous opportunities to enter the market daily. However, quantity does not equate to quality. We want to use strategies to take the best advantage of the best opportunities. The best opportunities have a consistent footprint that passes detailed examination. There's all types of markets, what do I want to call them? Market bigwigs. There's all kinds of media people out there pushing this. There's all types of gurus pushing that. The fact remains, we need a plan. We need to plan out our trade, and ultimately, we need to understand exactly what we're going to do and how to filter it down. So it's important to us as traders to refresh these criteria in our mind before trading. You need a set of rules to guide you in your trading opportunities. And then we want to build our strategy. And one of the keys here is continued education. Okay. If you think of trading like back when you were a child, at first you learned your ABCs. And then after you learned your ABCs, you learned how to spell cat and C and rat. And then you learned to make small sentences. And then you learned to make bigger sentences. Then you were able to add in other words. Then you were used to use a larger vocabulary. And even today, we're still upgrading our writing style, our vocabularies. We're using words today that we never used before because we're constantly educating ourselves. We're staying in front of the world. And same thing with building your strategy. You want to continually stay in front. So when we were in elementary school, we learned our ABCs and our 1, 2, 3s. We eventually got to the point where we could write sentences and even solve quadratic equations. Developing our trading prowess is no different. We begin by learning the fundamentals, then we progress forward. In doing so, our techniques and strategies become consistent and our results improve. Now, I know a lot of you getting very bored. I know a lot of you saying, oh, I don't want to waste my time with this. But the fact is, you can either be the guy sending me the nasty email saying, I lost all my money, and I don't ever trade anybody's money. I'm not anybody's analysis. But for some reason, because I'm in education, they like to send me emails and they like to say, I want to blame that one or this brand or that thing. But it isn't. It's the guy who didn't want to learn, didn't want to put the time in, didn't want to make the effort, and just wanted to follow. He wanted a step-by-step booklet. I'm telling you, if I wrote a book, okay, I made it just 10 pages long and said it was your 10 steps to making a trade. And I said, do this. And when that happens, do this. And when that happens, do this. You know what? It would sell out like crazy. If I wrote that same book that said, go in the market and test this. And when this happens, adjust this. And it would sell like garbage because everybody wants to be led to the water. Not going to happen, boys. Now, today, traders have all the modern computer methods for interpreting price and buying trends. No matter how sophisticated you get, all traders must get back to the basics and simple Forex trading to be successful in the long term. So, where do we start? Okay. I start with 3 important pieces of information. Everyone, and you can have as many trading strategies as you want. Okay. I have my reversal trading strategy. I have my price action. It all depends on what the market's doing, what I see in the market, what opportunities presenting itself, what strategy I'm going to use. Now, you're not adjusting your strategies to give you a trade. But like when I use my indecision candle strategy, I have to have these 5 things coming down together. If those same 5 things aren't on my chart, then I can't use my indecision trade, but I might be able to use my reversal strategy, and that might work because it might be a reversal trade setup, not an indecision trade setup. So the first thing I do every day, every single day, so that I can see my trading opportunities, is I put support and resistance on my charts. Now, I'm not going to tell you what type of trader you have to be. Okay. The world's changed drastically in the last 10 years. The CFD trading and online trading and Java charts and HTML charts. When I started trading, we sat in the pits, we hand charted, and we didn't have internet. We didn't have any communication. We had a ticker tape. So we were very limited in what we could trade because I sat in the commodities broker's office in his pits and I traded livestock. Okay. And then a couple of years I traded agriculture. But you know what? If I'm tracking my orange juice, I'm tracking my coffee, I'm tracking my cotton, I can't by hand keep track of more things than that because I'm putting on my charts. I'm drawing my charts this up. I'm doing it by hand. I'm drawing on my support and resistance line. I'm looking for all the USDA reports. I'm trying to watch all the news, but the markets were slower. Today, you have 1,000 assets at your fingertips. Okay. Now, I'm not going to tell you you can't trade Facebook and then go over and trade the euro, and then from the euro go over and trade oil. What I'm going to ask you is first decide what asset you want to be an expert in. Because if you limit those group of assets, you can actually start to get to know them, and your charts will all be ready and set up for you. Because like I said, I start out the first thing every day putting support and resistance on my charts. This is my teaching chart. It'll pop on your screen first. And this is the Euro US dollar 1 hour chart. I use this chart or a 30-minute chart of the Euro US for every teaching class. Now, as you can see, across my charts are my support and resistance lines or levels. They're color coded. Okay. They're color coded in my personal codes that tell me something. Okay. They could be how long ago that those prices were important, or how many times I saw those prices supported. You decide how you would like to see them on your charts. You can have zones, which is something I advocate. So here, instead of having a support and resistance level, you can actually see the zone. Here, this line, solid, dash red, dash gold. They mean something. And I have the keys and ledgers to each one of my charts to tell me exactly what I want to see. So I can interpret, because once you have your support and resistance lines on a chart, you don't have to keep drawing them on. They're sent forward historically. So anytime that the euro is trading around the 112, 111 range, you're going to have these same levels of support and resistance on your chart. I also immediately put on my trend lines because I want to see if price is actually trending. Now, in this case, first of all, we can see trend before we see trend line. Now we can see the euro US dollar has been steadily trending down. It's been trending down since here. And we've moved all the way to here. Okay. This morning, or when I set up this class right before we got ready, I went on here and looked for a trend line. I was actually able to extend a trend line forward at that point. It wasn't a validated trend line because I didn't have 3 touches of the trend line at that point. Now we can see the last candle jumped up, so I have to adjust my trend line. And technically, I could push this as a validated trend line. 1, 2, 3. So I have my support and resistance. my trend line. And guess what? We're now building parts of our trading strategy also, because we have some very important lines that might help us make a trading decision, or at least maybe give us an alert. But these should be drawn on every chart you're looking at. And every one of your trading strategies should start with, okay, do I have a major support or major resistance area? How is price reacting to support and resistance? Hold on a sec. There we go. So the only thing I place on my charts is support and resistance. I use these areas in conjunction with candlestick analysis to trade. Okay. Now, support and resistance areas show where to buy and sell, and they are vital parts of every trader's toolkit, and it's essential to learn how to place them. Placing support and resistance area is the most important skill you can master and should be in all of your trading strategies. And placing them is easy. Support and resistance divide your charts up into buy and sell areas. An area that sits above current price is a sell area, and any that sits below current price is a buy area. When price approaches a sell area, large amounts of sell orders are triggered, countering buy orders. This usually results in price stalling or even turning around completely for a reversal. Why does this happen? It's simple. The market movers like banks and hedge funds place their orders at areas of support and resistance. Good traders don't randomly place entry orders and hope they get lucky. They place their entry orders at significant price levels. Significant levels come in many forms. So I'm going to share with you a little prepared presentation on how to go about placing your support and resistance areas on your charts. And then we're going to combine it with a couple indicators to build our trading strategy.
Okay, so here we have the daily chart of the FTSE 100, and as you can see, currently the price is up at the 7,300 level and has spent the last couple of months around the 7,000 level. Now, to demonstrate how to identify and plot support and resistance areas, I'm going to scroll back on the chart to the last time the price was in the same region as it is now. This way we can use the support and resistance areas we plot from the previous price action to see if they have any significant impact on this price action that's happened over the last few months. So I'm going to draw two red lines, one above this price action and one below, very quickly. There we are. Now we want to scroll back and find the last time that the price was between these two lines so we can use it to identify and plot the support and resistance areas for this price region. So if we scroll back, we find that the last time price was in this particular region was sort of December, January to August 2016. So in order to start plotting the support and resistance areas, we first need to identify where they are. And as I said in the video previously, we need to spot the points where price has had a significant reaction. And to do this, we want to find where price has either been heading in a particular direction, has stopped and reversed, like here, or where it has stalled for a significant amount of time before either breaking through a particular area or reversing. So this area here, for example. And to plot these areas, I'm going to take my circle tool and I'm just going to first pick out all the reactions that I can see on this particular region of price action. So as I said before, I'm just picking out all the reactions where price has either reversed or stalled, and I'm just highlighting them so I can see them more easily. Fantastic. Okay, and now to plot the areas, I'm going to take my line tool and I'm going to work my way down the chart until I come to a reaction point. So the first reaction point I come to is this one here. and I want to encapsulate this reaction with the two lines. So I want to take the highest point the reaction occurs, and I want to try and place my line at the lowest point where the reaction occurs. And then once I've done that, I can delete my circle. So here we have our first support and resistance area. And then all we're going to do is work our way down the chart, picking out these reaction points, their lowest and highest levels. Another one here. Another one here. This one has more than just a one reaction from it, which is fantastic as it gives this particular area a little bit more weight in future use. If we come down a bit further, we've got this one here. To there. Actually, this one could probably come a little bit lower and encapsulate that reaction as well. And then we've got one down here. To there. Got another one here. To there. And then we've got another one here. To there. And then we've actually got another one here to there. And then we can delete our circles, as all of these reactions should now have been encapsulated in the areas that we've drawn. So that one has, yep, yes, 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 yes.
Okay, so now that we see how to draw our lines of support and resistance on our charts, and it seems a little boring and a little time consuming, but once they're on there, the next time the asset comes back in that range, you already have them on your charts. Okay. And you should be using these all the time, regardless of how you're making a decision. Now, to build this into our strategy, we're going to add on our next step, and that's candlestick analysis. Don't get freaked out. Most new traders learn a little bit about candlestick analysis, but most of what they learn is completely useless, because what most people have tried to tell you is to learn pattern recognition, to memorize all of those patterns. There's technically about 32 different candlestick patterns that make up the majority of candlesticks, but there's hundreds more. And you're supposed to memorize when you see this and you see that and you see that, you're supposed to do that. Well, it doesn't really work in real life. But you can't skip straight through to candlestick analysis without knowing the basics. And if you know the basics, that's fine. We've got you covered. Okay. When Forex traders first start out, they usually learn about candlesticks. But what they learn is usually useless. They normally see a list of candlestick patterns like here: the hammer, the inverted hammer, the doji, the spinning top, the star, the hanging man, the doji, the spinning, bearish spinning top. You learn about Hammurabis, you learn about Marabuzus, and you're told to find these on the charts. Well, today we're in fast-paced markets and Forex trading, which takes place in very short time frame. And when you start looking for these to appear on your charts, because what appeared 2 hours ago is unimportant to us, what appears now. It gets mind-boggling, and most people just get fed up with candlestick pattern recognition. But this is not candlestick analysis, it is pattern recognition. And for a price action trader, it's useless. Actually, it's worse than useless. Thinking about candles as just patterns is counterproductive. It makes you a worse trader. Why? Because each pattern is given a set of definitions and it leads you to tunnel vision. You're not really looking at price, you're looking for candlestick patterns. But all candlesticks need to be assessed based on the candlesticks around them and many other factors. So normally the truth is any candlestick can mean many different things at one time. Here we're looking at a spinning top, and it could mean a reversal, but it can also mean a continuation. So we need to use candlesticks to tell the story of price, not pattern recognition. So we've got our support and resistance levels on our charts. And every single candle on your chart is telling you a story. When you combine these candles, you get the story of price. So let's break down the story of price. So if we're looking at these three highlighted candles here, it's easy to conclude that the sellers are in control. Right? We see three red candlesticks. After that, we see four green candlesticks. We can say the buyers are in control. Okay, that's fine. So in this case, the candles all closed lower than they opened, and they all created new lows beyond the previous candle low, and they all had small upper wicks in comparison to the candlestick body. So you would say that the bears are in control. But what does this next candlestick tell us? Okay. It has a short upper wick, it has a small body, and a long lower wick. I don't care what somebody wants to name it. I don't care what anything else is about it. Okay. I've got bears controlling the market. And then I get this little tiny candlestick, which is what we call an indecision candle. Indecision candles occur when neither buyers or sellers can gain or maintain control. And indecision candles happen all the time. But they are only valuable to us in our trading strategy when they appear. Okay, so first you have to have a bullish or bearish movement. Whether it's three candles, five candles, it can be three green candles mixed with two red candles. You're seeing a steady move up or a steady move down. You're being able to say that somebody is controlling the markets or in control of the markets. Then that indecision candle forms. But where does that indecision candle form? It forms directly on your support or your resistance zone. You, like I said, in a trading day, you get zillions of indecision candles. They appear here, they might appear here, they might appear in here. We don't care because what we're only looking for is we're combining at this point two things together. We're only concerned when that indecision candle appears in that support or resistance area after or when we have somebody in control of the markets. So in this case, we would say the bulls were in control of the market. And then we get the indecision candle. Now, the indecision candle does not have to be the opposite color. An indecision candle is what? Short upper or lower wick, depending on which way it's formed. Longer upper wick, but it's a small body. So when price hits resistance, we get an indecision candle form. Okay. And this candle tells us a story. Now, altogether, this indecision candle forming right after a strong bullish candlestick suggests that the power has shifted decidedly from bullish to an undecided market. But there is one more thing. The indecision candle is forming on top of a resistance area or a support area if it's the opposite. If you remember, we talked about resistance being a sell area and support being a buy area. So the image that we saw here, okay, tells us what? Wham, bam, thank you, ma'am. We've now got the indecision candle forming directly on a buy or a sell area. Price stalls and we get indecision forming on top of that area. So what we use is we use a simple candlestick analysis as our second part of our trading strategy. We haven't decided to buy or sell something yet, but this story gives us a nice little price action trade setup. Price action allows you to make many different types of trades. reversals, continuations, range, swing, breakouts, and scalp trades. Okay. In this case, we're using what's called a reversal trade setup. So a reversal trade comes in three parts: the preceding trend, not trend line, just trend, the indecision candle, and then the reversal trend. So the preceding trend is either bullish or bearish. Okay, we've got it noted by 3 candles. It can be 5 candles, it can be 7 candles, it can be 9 candles, and it can be an intermix of some green and some red, and some greens, just so that the trend is in a definite move. And it could be, like I said, it could be 3 15-minute candles. So that trend could be over the last 45 minutes. And then we get so the preceding trends is simple. If you see a strong move heading into an area of support or resistance, you could consider it a preceding trend. But then we get the important one. We get an indecision candle needs to form on or near the support or resistance area. If the indecision candle does not form on or near the area of support or resistance, it's not a valid reversal setup. Just move on to something else. Why does it need to be on support or resistance? An indecision candle and a bullish preceding trend indicates that buyers are possibly losing control. We're not sure because the trend can continue straight up after the next move. It's telling you the markets have shifted to indecision. Somebody still has to make a decision. However, an indecision candle does not indicate the price will reverse with any degree of certainty. An indecision candle indicates only one thing: indecision. So you cannot take a trade based solely on indecision. So what do we have now? We have our support and resistance lines. We have our preceding trend. We have our price analysis or our candlestick analysis, and we're waiting for that we get the indecision candle. Now the reversal trend is the third and the most important part of the reversal setup. This is where we make our profit. After a preceding trend stalls at support and an indecision candle forms, you often see a reversal trend. Okay, you can see it in the background here. So in this case, we saw a transition of power from a bullish preceding trend to a bearish reversal trend. So where would you enter a trade? You know what a reversal trade looks like. You know what you need to enter after indecision and before the reversal trend begins. So you can't wait for those 3 candles in the opposite direction to make a trade because you've lost your profit. So the first thing you have to be aware of is sometimes you're going to be right and sometimes you're going to be wrong. When you get the indecision candle, you need to enter a trade after that indecision candle is closed. You can't wait for confirmation, but you do this by setting up your entry point and your stop loss. Entering a trade does not need to be difficult. Remember, my goal is to keep it simple. So getting in at the right time. So I explained that the reversal comes in 3 parts: the preceding trend, the indecision candle, and the reversal trend. You need to enter the reversal trade after part 2, the indecision candle, has closed, but before part 3, the reversal trend, completely takes off. Obviously, if you enter after the reversal trend takes off, it's too late. You also need to make sure you do not enter too early, as you could be entering a false setup. So this can happen at any time. You get bearish move, indecision candle, and you would be waiting for the reversal, and it could trade against you and just continue on farther down. It's gonna happen. Failed trades happen. There's nothing you can do about them. But getting in at the right time lowers your percentage of failed trades. Many people wait for the candle close to get in, but I have tested this early, and waiting for closes gets you in too late. In the image, you can see that the first candle in the reversal trend closing far from support. So if you had waited here, this finished, it's now closed, and you wait for this candle for confirmation, you try to get in here, you've most likely lost your profit, because by the time you get in, it's going to be bursting off of this uptrend or get stalled out here. So what you want to do is set up a buy right above the high of that indecision candle. So if the market does move up, it triggers the buy. If it ends up coming down, it doesn't ever trigger your buy. You would put your stop loss at the low of that indecision candle. So even if it were to move up, you would to execute your trade and it would fall back down, you would close out in the market with a small little loss. Because you have to remember, losses are part of trading. It's minimizing your risk. This means if you waited too long, you miss out on potential profit. The key to reversal trading or trading any of this matter is getting in the right timing. Okay. So you set your entry point at the high or the low, depending on which direction it's going, of that indecision candle, your stop loss on the opposite side. Now you need to calculate your risk reward ratio to make sure it's within your trading means. And in trading, a lot of people tend to overcomplicate simple concepts. Sure, some of the concepts in trading are not the sort of thing that you would intuitively know, but many things are easy. You just need to know what to look for. So that gives you a little idea of how to set up our triple header strategy, but there's one more piece of information I'm going to give you before we go. So let me pop up my live charts here. And there's one more clue that we need to see, and this is called volume. If we see price reaching that indecision candle, we should see volume contracting. If you set your entry point above the high of that indecision candle, by that point, we should see a jump in volume. If you don't get a jump in volume, there's something wrong with the trade. It's your clue. Okay. So you have support and resistance, candlestick analysis, and finally, a volume to confirm. And then on that note, I'm going to say goodbye to everybody. Thank you very much for joining us. If you want to know more about trading indecision candles or trading setups or building strategies, go to www.legacyfx.com and go to their education center. And there you can find all the material you need. Thank you very much and have a great trading day. Bye now.